Morning, guys. Today we're going to look at a couple of things. First of all, record-keeping systems for finance, and secondly, a brief introduction of double entry accounting. I'll go through this in more detail once we're back in the classroom, but we'll touch on it today. So every business has a record-keeping system so they can keep track of all their financial transactions. In the old days, it used to be a paper ledger, a large book, where basically every transaction was entered into it and every debit and credit recorded out of it. These days, it's now mostly computerized. Many small businesses just use things like Excel spreadsheets, or they're moving into more of the online record systems such as Xero or MYOB or QuickBooks. Key part of financial management is the system of double entry accounting. It means every transaction's accounted for twice in a ledger. Once as a debit, once as a credit. Now, the confusion that arises for most people is that you're used to reading bank statements. And when your account is in credit, it means it's positive in your account. And when it's in debit, it means you owe money. The problem is that these statements are written from the bank's perspective, and a credit is something that they owe, and a debit is something that they own. So it looks like credit means it's positive. It's actually the opposite. An accounting system. A debit is something that's an asset or a positive, and a credit is something that you are withdrawing money from. Again, we'll go over this in a lot more detail, but it's just fundamental to get this concept that the bank statements are written from the bank's perspective. So money that you have sitting in your account is money that they owe you, so it's a credit from their perspective. Whereas if you have a mortgage, that account will be in debit. It's money that you owe them. Now, the reason why they do this double entry is so that all accounts actually balance. So, for example, if you go and buy a television on account and it costs you $1,000, you take the television away. In the accounting system, they'll enter that as a debit in sales. So $1,000 will be debited to their account. When they send you the bill, they enter that as a credit, saying it's money that they owe you. Right. So when you actually pay the bill, they then debit that $1,000 from the invoice section, so accounts payable, and they debit the cash at bank. So the money's actually gone out of accounts payable and now moved across into cash at bank, so money they're available to spend. So this way you can keep track of where all these transactions are going, who owes what, and how much cash you have on at any one particular point in time. As you can imagine, on large corporations, this becomes incredibly complex. And so they use basically the small ones using things as I say MYOB, QuickBooks, or Xero, which is one of the world's most popular ones now. But the large corporates use much more complex and larger accounting systems such as SAP. For example, the Department of Education is run on SAP. Anything to do with purchasing, paying invoices, human resources, keeping track of leave, all that is done through the SAP system. Most large government departments in Australia use this system. Now, a graphical representation of double entry accounting. Now, if you recall from the preliminary course, we talked about the accounting equation. This is the one thing you need to know. You absolutely have to remember this because it makes everything else about finance much more clearer. So on the left-hand side of the equation, we have the assets. That's everything the business owns, right? And on the other side of that, we have the liabilities, which is everything the business owes, and the difference is how much the business or the owners have invested in the business. That's what they get to walk away from. So if you sold everything that the business owns and you paid off everything they owe, the difference will be what the owners then will walk away with. All right? And as long as that's positive, the business is solvent. If that's negative, the business is insolvent and is legally required to cease trading. Now, where it gets a little bit confusing with double entry is when the difference between the debits and credits. Right? So, for example, if someone pays you $1,000, that gets debited to your cash at bank account on the asset side of the ledger. Somewhere else over on the other side, in the owner's equity side, that would be credited. Right? So those two equal out. And you'll notice there's no money owing, so the $1,000 in the cash equals $1,000 in the owner's equity account. Now, when you pay 500 of that to your supplier, that then gets credited from the asset side of it and debited from the owner's equity side of it. So it continues to balance out. So this equation must balance. If it doesn't balance, there's a fault in the accounting system, and basically accountants will spend hours and hours and hours going through every transaction trying to find out where it went wrong. So the key thing is this must balance, and this is effectively what is shown on a balance sheet, which we'll go through in a bit of detail later. Everything you own is on the left-hand side, everything you owe is on the right-hand side, plus the difference, which is the owner's equity. So here's an example of double entry accounting. All right, so the 1st of April, the balance brought forward, money in the bank was $4,300. Basically, their capital, what the business owns, $15,000, and they have a loan of $5,000 that they've loaned out to someone else. They've delivered services for $10,500, and people owe them, the debtors owe them $5,000. So their total assets is $39,800. Now, on the debit side, so assets that are worth an amount of money have a credit balance to equal on the left-hand side. So the baking equipment that this company is using to make stuff, the baking equipment is credited for $12,000. Drawings is money that the owners are taking out of the company, so they would take $500 out of their bank account. That's credited to that side of the equation. Salaries are what they're paying the staff, $4,000. Creditors are people that they owe money to, so that could be things like the phone bill or rent, and then a loan payment for $4,000. So all of those accounts, all those add up to $39,800 each. All right. Hopefully that makes things a little bit simpler. We'll go into this in more detail. As I say, we'll do some practice examples once we get back to school.